Hello and welcome back. In today's video, we will be revisiting a particularly favorite ETF in the income investing community, the Hamilton Enhanced US Covered Call ETF with the ticker symbol HYLD. I had done a review of this ETF about 7 months ago. In that video, I had explained how I originally bought this ETF as soon as it came out in February 2022. And after some good initial performance, how I was very much disappointed with the portfolio rebalancing done by the management at the time. If you look at the all time chart of HYLD, you will notice that from April 2022 to October 2022, the ETF experienced a sharp decline in capital value, but never really managed to recover. My previous video explains why this decline happened and why the stock price did not recover like the rest of the stock market. Yes, the overall stock market was not doing well at the time, but the management also made a poor portfolio rebalancing choice, and the timing of this rebalancing was also quite bad. So, if you haven't seen that video yet, do check it out. But in today's video, I want to review the current version of HYLD, which has gone through a great number of changes in the past few months. I must say that almost all these changes have been in the positive direction. HYLD today represents a much better investment compared to the version available back in February 2022. So, in this video, I will mainly discuss the nuanced differences between its current version and the older version, as well as provide some insight regarding how well the ETF is actually doing when compared to the S&P 500 index, whose sector mix it claims to replicate. Back in June 2023, Hamilton hired Nick Pickard as the chief options strategist. This hiring represented a major shift in the management's focus when it comes to their ETFs. Prior to this, they had only two covered call ETFs, HYLD and HDIV. If you look at the composition of both these ETFs prior to the arrival of Nick Pickard, you will notice that both of them were baskets of third party ETFs. At first glance, this might seem like a good strategy. It is a one stop solution for buying a variety of ETFs which are diversified across different sectors, and each of them is actually using a different covered call strategy. So you're getting diversity in terms of its holdings as well as the covered call strategy used to generate income. But there is a flip side to these advantages. Since all these ETFs are managed by other companies, Hamilton does not have any control over the holdings within these ETFs. So the diversity in terms of sector mix that Hamilton was aiming for may not be similar across all the holdings. Also, some ETFs might have more aggressive covered call strategy than others, resulting in different capital gains and losses for each holding, which may not reflect the overall market performance accurately. This was certainly the case with ETFs like QYLD, where the options were written on 100% of the portfolio, as opposed to other ETFs like TXF and GLCC, where the options were written on up to 33 to 50% of the holdings, allowing the remaining portfolio to grow along with the rest of the market. Again, Hamilton would not have any control over any change in strategy of covered call writing within these ETFs. This begs the question, why didn't Hamilton create their own in house ETFs with their own in house covered call writing strategy? This is where Nick Pickard comes into picture. Since Hamilton did not have their own options strategist, it was not possible for them to introduce their own in house covered call ETFs. By the end of the day, trading options is a risky business, and when you're doing it on a grand scale by managing other people's money, you need a specialist with several years of experience. With the arrival of Nick Pickard, Hamilton were able to introduce their own in house suite of covered call ETFs known as the yield maximizers. All these ETFs are managed by Nick Pickard. They even mention his name on each of the ETF webpage, even highlighting how much experience he has when it comes to managing such ETFs. All of them follow a very similar strategy. They write at the money monthly options. The percentage of portfolio on which the options are written varies between 30 to 50%. The table on the screen shows you the percentage of moneyness for each ETF. From this table, we can see that each of the ETFs is retaining at least 50% of capital upside. Now, if we take the current holdings within HYLD and compare it with its previous holdings, it becomes quite clear that the current mix of ETFs is much better. Previously, ETFs such as QYLD, XYLD, and RYLD were sacrificing 100% of the upside, whereas in the current mix, all ETFs retain at least 50% of capital upside. But it gets better. All these ETFs follow the same strategy and are managed by the same team within Hamilton. Hence, Hamilton has complete control over the strategy and holdings within these ETFs. Last but not the least, as an investor, it is cheaper to hold these ETFs since there is no additional management fee being charged. We pay a management fee for each ETF within HYLD, but nothing for HYLD itself. Whereas in the previous version, we were paying a management fee for each holding within HYLD, as well as a separate management fee for HYLD. All these advantages I mentioned for HYLD are also applicable for HDIV. So it is quite clear that HYLD is a much more improved product than what it used to be in the past. But how good is it when it comes to replicating the returns of the S&P 500 index? Let's take a look. On the Hamilton website, it is mentioned that the HYLD ETF is designed to replicate a sector mix which is broadly similar to the S&P 500 index. But how accurate is this claim? Let's take a look at the actual sector percentage in HYLD and compare it with that of VFV, which is the Vanguard S&P 500 Index ETF. If you observe both charts on your screen, you might notice some minor differences, such as HYLD is heavier in the technology sector, which in turn lowers its exposure to healthcare, consumer discretionary, and financials. Also, in the industrials and consumer staples sector, its exposure is almost half as compared to VFV. But overall, the claim of the sector mix being broadly similar to the S&P 500 index is not wrong. The keywords here being broadly similar, which means it is not going to be an exact replica of the S&P 500 index. But this has also helped me realize an important fallacy that a lot of investors, and certainly myself, has fallen into, which is thinking that a broadly similar sector mix would also mean a similar number of holdings. Now, that can't be further from the truth. HYLD is a basket of 7 different covered call ETFs which focus on various different sectors. Here I'm going to exclude HBND from my calculation of the total number of companies held because it is a bond yield ETF and does not actually hold any companies. Also, at 2.3% of the HYLD's total portfolio, it is not really going to have any major impact on HYLD's total return. So, if we look at the remaining 6 ETFs, we find that they hold anywhere between 14 to 25 companies, with SMAX, the US equity ETF, having the highest number of holdings at 25, and AMAX, the gold producers ETF, having the lowest number of holdings at 14. If you take the total, it comes to 110 companies, which is far less than the 500 holdings within the S&P 500 index. But wait, this number is not accurate because a number of companies within these ETFs actually overlap. For example, both SMAX and QMAX hold these companies. Even though SMAX has a total of 25 holdings and QMAX has 15 holdings, put together, their actual total holdings combined is 31 companies instead of 40. when we take the overlapping of the holdings into account. When we do the same calculation for all the ETFs held within HYLD, the grand total comes to 91 companies. So, despite offering a sector mix similar to the S&P 500 index, HYLD's diversification in terms of its holdings is less than a fifth of the S&P 500 index. This could end up being a negative factor because there are companies within the S&P 500 index with a smaller market cap which could go big in the future. Take the example of Nvidia. Today Nvidia is in the top 5 holdings of the S&P 500 index and certainly a top holding within the technology sector. But 5 years ago, it had a much smaller market cap and wasn't considered a major tech company. Since HYLD's holdings are chosen based on sector allocation, it is possible a company like Nvidia would not be included in the ETF until after it has become big, which means missing out on capital gains which would have been available if the ETF had simply held all 500 companies within the S&P 500 index. If you look at the holdings of QMAX ETF, it only holds the top 15 tech companies. This begs the question, are there any smaller companies in the S&P 500 index which are not listed over here, but which might go big in the near future? So, one way to look at HYLD is that it is a more concentrated version of the S&P 500 index with a similar sector mix but only the top 90 companies plus a bit of exposure to the bond market with the HBND ETF. It is not exactly a bad thing, but it is important to be aware of what the product is actually offering. Simply looking at the sector mix, a lot of people may assume that in the long term it will perform similar to the S&P 500 index, which may not be the case based on the actual number of companies it holds. So let us summarize everything we have learned in this video. HYLD is clearly a much more improved product than what it used to be a couple of years ago. The ETFs held within HYLD are Hamilton's own in-house ETFs, using the same covered call strategy throughout, which provides a mix of growth and income. Also, this reduces the management fee, which used to be higher back when HYLD held third-party ETFs such as QYLD. The other important factor is that HYLD indeed has a sector mix broadly similar to the S&P 500 index. However, it holds far fewer companies. This lack of diversification in terms of its holdings may bother some investors, especially those who want exposure to the S&P 500 index. And in the current market, we do in fact have another covered call ETF, USCL, which provides exposure to the S&P 500 index with a mix of growth and income. By the end of the day, investing in any ETF comes down to the mix of pros and cons associated with its strategy and holdings. So, in my opinion, HYLD is a fairly good investment in the current market for those looking for covered call income. However, there are newer ETFs in the market which offer similar income potential and greater diversity in terms of their holdings. It will be interesting to see if the management at HYLD can improve the product even further. And with that, we come to the end of today's video. Let us know in the comment section if you already hold HYLD or are planning to invest in it. As always, the information presented in this video is based on my research and conveys my opinions. It does not count as investment advice. Please do your own due diligence before making any investment decisions. Thanks for watching. If you found some value in this video, don't forget to like, share, and subscribe. I will see you guys in the next one.